Hello, everybody. Hi. Oh, this is a really big auditorium. I totally cannot see anyone at the back. First of all, a very good afternoon, and thank you so much for being here. Usually, I say that Saturday is a very precious day because Saturday is a good time for napping. It's a good time for spending time with families, and all that. So I'm really grateful that all of us are here. And big congratulations, of course, to My Money. This is the 10th year that we are doing My Money. So I've been given the topic on managing your money in changing times. Yeah, this is my topic, or rather planning your finances in changing times. Now, I do not know what changing times means to you, because some of us may think that, come next year, time is really going to be very bad. I think there's going to be an economic crisis. I think there's going to be a financial crisis. I think that there might be a recession. I don't know. Yeah, I do not know what changing times means to us really. But when I was looking at this topic, I was thinking, how do I approach this topic? Sharing with all of us, how can you manage your money in changing times? And I want to start first by telling you this, that recession is coming. Recession is coming. Or some people say they're already here. But for those of you who have been attending my talk in the past, you will actually be very surprised or very shocked to hear me say that. Because Chris Tan is no market commentator. I have no market view. I don't make predictions at all. I actually do not know whether next year a recession is coming. So why am I putting up a slides to say that recession is coming? Because at least that is what the yield curve is telling us. Now, what is the yield curve? Some of us are very familiar with the yield curve, but I'm not going to assume that everybody understands what is a yield curve, so I'm going to explain it very quickly. A yield curve is a curve that shows the yield of the bond of different maturity. Yeah, so I don't know whether I'm not sure whether you can see, okay, I can't point to the screen, but if you look at the left side, the blue curve, and that is the normal yield curve, you will see that at the shorter end on the left-hand side, when the maturity of the bond is shorter, the yield is lower. As it goes to the right, if the maturity of the bond is longer, the yield is higher, and it makes logical sense, right? Does it make sense to all of us? Okay, I can't see you, okay, because this light is really bright. Okay, so you gotta just tell me whether I'm clear or not. Yeah, I'm sure we all understand this, yeah, because it's like you putting your money in the fixed deposit. The longer you put your money in the fixed deposit, it just means that your interest will be higher, right? If you put your fixed deposit for a shorter period of time, then the interest will be lower. Does it make sense? This is the same with the yield curve, right? So same with the bond. So if you buy a shorter maturity bond, the yield will be lower. If you buy a longer maturity bond, you expect the return to be higher. And that's why it is a normal yield curve. On the right, you see an inverted yield curve, and the yield curve can invert. In the inverted yield curve, the right-hand side, which is the bond of longer maturity, the yield is actually now lower than the bond of shorter maturity. How can this happen? There are many reasons why a yield curve can be inverted. Yeah, but some of the common reasons would be that if you are a bond investor, and if you think that the economic outlook is bleak, no good, it's grim, then the inflation expectation will be low. Makes sense, right? Economy is no good, your inflation won't be high, the inflation will be low. And if the inflation expectation is low, this is actually good for bonds, especially longer dated bonds. And so a bond investor likes it, and he buys the longer dated bonds, and thus it pushes the price up. And when the price goes up, the yield goes down. Does it make sense? Yeah, the more expensive, all of us understand property. If you buy property at a very high price, your rental yield will be higher or lower? Lower. So same, if you buy the bond at a very high price, it just means that the yield is going to fall. And this is what happened from a bond investor standpoint. If you're a stock investor, and if you think that the economy is not going to do well, it's an expectation that the economy is not going to do well, then what you're going to do is that a lot of stocks investor will then switch their money from stocks to bonds, and thus putting bond price, the longer date bond price up. And in the same way, yield will fall. And as a result of that, you get an inverted yield curve. And many investors, including professional investors, use the yield curve to predict a recession that may happen in the next 2 years, or to be specific, in the next 21 months. And as a result, they use it to make investment decision. And sometime this year, about 7 to 8 months ago, the yield curve actually inverted for 5 days. And that caused some panic in the market. But is the yield curve a reliable tool to predict market crashes? Well, so we did some study, and from 1976 to 2018, there were 5 or rather 8 times that the yield curve inverted, left column. Yeah, but out of these 8 times that the yield curve inverted, only 3 times, the stock market actually crashed within 2 years. The remaining 5 times, the market did not crash. So you can see that the yield curve is not actually a very reliable tool to predict the stock market crash. And if I show you the next chart, okay, and I can't point it again, but let me explain. Okay, the blue line that you see that goes all the way up from the left to the right, that's the S&P 500. The orange line, it's a bit technical here, but the orange line is the difference between the yield of a 10-year treasury bond and a 2-year. Okay, that measures the difference between the yield of a 10-year and the yield of a 2-year. So you can see from the left side, you see the orange line going up, and then it comes down, and once it goes down below 0, that's when the yield curve inverts. Are we okay? So you see all the, like I said, because even if I point, you can't see it. Yeah, you see all the vertical lines that are in gray. Okay, it intersects with the orange line at the 0%. That is the point when the yield curve begins to go negative. But what this chart tells you, and I hope it encourages you, is that regardless of whether the yield curve inverts or not, or the number of times the yield curve inverts, the stock market always go up in the long run. Can you all see that? That's the S&P 500. It goes up in the long run. So the yield curve is, like I mentioned, it's not a reliable tool to predict. Okay? And the market goes up in the long run regardless of the yield curve. And does it mean then that this yield curve is a useless tool? Or does it mean that economic data tools are useless and we should not use it? Obviously not. It is useful. It's just that sometimes we use it wrongly. And I'm going to explain that in a short while. But I just thought I'm going to show you my favorite picture, and some of you who have attended some of my talks before will know that I love this fantastic picture. So I'm going to ask us to switch to the PDF. Okay, I'm going to show you this matrix. Can you all see it? If I zoom out, you will see there are a lot of numbers. Okay, this is the annualized return. You can see all the numbers there, right? This is the annualized return of the S&P 500 since 1926. So let's take a look at, let's zoom in and look at 1926. Okay, really big. So how do you read this? So you look right at the top, 1926. If you started investing in 1926, at the end of 1926, you get an 11.6% return from the S&P 500. Okay so far? If you stay invested until 1927, you will see 23.9. Can you see 23.9? If you come down, 23.9. That 23.9 is the average return of the S&P 500 per year for the 2 years that you stay invested from 1926. What that means is that cumulatively, you would have made about 48%. So you take 48 divided by 2, it's about 24%. Is there 23.9? That is the average return for the 2 years. Are we okay so far? If you come down further, you see 30.1. That is the average return per year for 3 years. So cumulatively over a 3-year period is a 90% cumulative return. And you come down, it's 19.2, you realize that the market has collapsed. And then it goes down further, you see 8.7, it's collapsing some more. And by the time you reach 1931, it's a negative 2.5% return per year over a 6-7 year period. You have not just lost the gains you made in the initial years, you have lost your capital. That period, if you remember, was the Great Depression. Okay, oh, I see from far, I thought I just started like 10 minutes and they showed me I've got 5 minutes left. But I just warmed up. Okay. Lou, is it really true I spoke for 15 minutes? Don't bluff. Okay, great. So all the red colors are negative returns. All the black colors are positive returns. Simple, right? Now, I've got no time to show you the 2008 numbers, okay, because they tell me 5 minutes. I'm going to show you a very beautiful picture. So, we are here. So, what is this? This is exactly the same diagram that I showed you earlier. It's just that I color-coded it. The red color represents negative annualized or negative average return. The green color represents positive average return, yeah? So you can make a few observations here. What is the first observation you can make? They're mostly green. Isn't that great that it's mostly green? If it's mostly red, life is going to be really sad. That's the first thing. So most of the time, the world is okay. Okay? Secondly, are there reds and pink, which symbolizes negative? Are there? Yes. They are at the edge, on top there, right? Yeah. Now, the observation we can make here is, now I do not know, when you start your investment journey, which is your journey? It could be that when you start your investment journey, it's like a 1928, you see it's bloody red, really red, and that's very sad. If you start your investment journey, it's going to be like that. Or it can be right on the right-hand side, you see a bit of red and pink there, that's actually 2008. It can be like that. Or if you look a bit backwards, okay, 2 patches on the right, red, and you see all the dark green color, that is the roaring 90s. If you start investing and every year is a green year, the average return per year is green, it's fantastic because you'll be thinking that there is no risk at all in investing in the stock market. I do not know. When you start investing, on Monday you buy into equities and you start your investment journey, I do not know how it will look like. But the one thing I know, even if you are hit with a very bad patch, and if I draw a line, and this line, can you see my red here now? Yes? Oh, now you can see. Can you see the red line? Oh, sorry, the black line rather. It shows you that I do not know where you start your journey, but as long as you cross over to the black line, you don't get a red year at all. Anything behind the black line, it's possible you get a red. Anything after the black line, you don't get a red. And if you count the number of boxes before you hit the black line, it's about 14 boxes. Each box represents 1 year. And it tells you that in the long run, even if you are hit with a very bad year like a major crisis, once you stay invested for the long term, and in this case it's 10 years, you will never see a year whereby it's negative again. But that's if we include the Great Depression. If I take away the Great Depression, which is really an outlier, and I move the line up, that is the last, you can see this is the last red or pink. If I count the number of boxes to the line, it's about 10 years. Now, I'm not saying that 10 years is the magical number. No, that's not what I'm saying. Yeah, but what I'm trying to tell all of us is that if you invest in the stock market, over the long run, the stock market always goes up. Why? When in the short term, there'll be a lot of ups and downs, but in the long run, the stock market always goes up because if there's one thing that drives stock prices, long-term stock prices, is profitability. What drives profitability? Demand drives profitability. What drives demand? Population growth drives demand. And in between, yes, there'll be a lot of noises. There'll be trade war. There'll be interest rate changes. There could be recession. There could be business cycle. That is going to cause the stock market to go up and down. But over the long term, collectively as the stock market, it always goes up in the long run. And there is no need to predict. And it's very difficult to predict. Anyway, scores of data have shown that even for professional managers, most do not beat the market. And for those that beat the market, they do not beat it consistently. It is tough to guess whether there's going to be a recession and how it is going to beat the market. My time is up, but I'm not coming down yet because I've got one more last slide. What does it mean for all of us? What does it mean for all of us? Let me summarize whatever I've said by the use of a money equation. We all have a money equation. All of us have a money equation. And our money equation starts with us having an income. And after we take away our savings, and after we take away our fixed expenses that we have no choice but to spend, like mortgages, like paying insurance premiums, so on and so forth, we are left with our variable expenses for us to spend. Whatever savings that we have, we invest it, we multiply by the return, compounded by the number of years. Hopefully that will help us reach our future goal. So there are two sides to our money equation, the left side and the right side. The The left side of our money equation is the short-term financial planning side, the boring side that a lot of times we don't want to talk about it. But this is the side of the equation that helps you become rich. Most people do not become rich through investing. Most do not. Of course there are, but most of us become rich through the left side, through earning a good income, through living below our means, having enough surplus and investing it. The left side helps us to become rich. And the left side of the money equation is the one that we can have better control. The right side is our long-term investment strategy. This is the side that helps you stay rich to beat inflation. But this is the side that you have a lot lesser control over because there's no way we can control market, and there is no need to control because over the long term, like I said earlier, data have shown that the stock market always goes up in the long run. This is the key. Economic indicators, tools for an investor. It is actually not meant for us to help us make long-term decisions. Rather, these indicators are there to help us make short-term decisions. Why? Because there is no need to change your long-term investment strategy just because of short-term information. It just doesn't make sense that we use short-term information to change our long-term investment strategy. So how can these short-term economic tools and indicators help us make short-term decisions? Let's say the yield curve predicts a possible recession in the next 21 months. Let's say it's possible. Nobody knows. But if you know that to be true, if all the economic indicators point to a possible recession going forward, then some of the changes you can make for yourself is, if you are thinking about changing your job, perhaps this is the bad time to change your job. Perhaps this is the correct time to be prudent with your expenses. This is the time that if you want to buy big ticket items, you might want to postpone it. It's going to help you make this kind of decisions. And this is a time whereby you avoid huge loans. It's a bad time to take up loans because we may lose our job. This is a time whereby we lower our expenses and build up cash for emergency fund. If you have not already built your emergency fund, this is the time to do it. And this is the time definitely to build up cash for what I call dry powder. What is dry powder? Well, nobody can predict whether a recession is going to come. Nobody can predict whether the market is going to crash. But if you have got dry powder, that means spare cash. When the market crashes, you're going to be really, really excited. Because this is the time whereby you go and put in some money when the markets have fallen. So let me end by saying this. Please do not make use of short-term information to make long-term investment strategy. It doesn't make sense at all. These information are very useful. Okay, and the next speaker, Mr. Song, he's going to come out and tell us about the economic outlook. As you hear this outlook, make use of it to make short-term decisions such as keeping your job, being prudent in your spending, don't take up too much loans. Well, if it is wrong, it's fine because you are healthier. If it's right, you are well prepared for it. And you can have some cash, put it into your investment strategy for the long term. With that, thank you very much.